Bitcoin has fallen into the 66K zone, and whenever Bitcoin reaches a level like this, the market becomes emotional very quickly. Some traders see danger, some see opportunity, some call it a normal pullback. Others start asking whether a deeper breakdown has already begun. But the most important question is not simply whether Bitcoin is down. The better question is what this move is actually testing. A sharp move into 66K is not just a price event. It is a test of liquidity, ETF demand, leverage, and market confidence. It is the moment where the market has to reveal whether buyers are still willing to defend Bitcoin or whether capital is becoming more cautious underneath the surface. Price is the loudest signal, but price alone does not explain the full story. A red candle tells us that sellers are active, but it does not tell us whether the move is driven by panic, forced liquidation, ETF outflows, macro pressure, or a deeper shift in how liquidity is positioned. To understand whether Bitcoin's fall into 66K is a real breakdown or only a liquidity test, we have to look beyond the candle. The first layer is market structure. A level like 66K matters because it is where confidence gets tested. When Bitcoin is trading higher, momentum can make the market feel stronger than it really is. Higher prices create belief. ETF inflows create the impression that demand is always there. But when price falls quickly into a major support zone, the market has to prove itself again. It has to show whether buyers are still willing to step in or whether the previous demand was more fragile than people assumed. This is the difference between a liquidity flush and a real breakdown. In a liquidity flush, weak positions are forced out, excessive leverage gets cleaned up, fear rises for a short period, and stronger buyers eventually step in at lower prices. It feels painful in real time, but it does not always mean the broader structure is broken. Sometimes the market needs to remove overconfidence before it can build a healthier base. But a real breakdown behaves differently. If Bitcoin falls into 66K, bounces weakly, and then continues to lose structure, the message changes. That would suggest the market is not only flushing leverage, it may be repricing risk. In a real breakdown, every bounce looks tired, sellers remain in control, and the market struggles to reclaim the levels it just lost. That is why the reaction after the drop matters more than the drop itself. The first move creates fear. The next move tells us the truth. ETF flows are important here because this Bitcoin cycle is not the same as previous cycles. In older cycles, Bitcoin was mostly driven by native crypto liquidity, retail speculation, offshore leverage, and broad risk appetite. But in the current cycle, spot Bitcoin ETFs have become one of the clearest windows into institutional demand. When ETFs are seeing strong inflows, the market can believe that larger buyers are absorbing supply. That makes dips feel more manageable. It gives the market a support story. But when ETF flows weaken or turn negative, the psychology changes. Suddenly, the market has to ask whether the same institutional demand that supported Bitcoin on the way up is still willing to defend it on the way down. This does not mean Bitcoin's long-term thesis disappears. It does not mean Bitcoin is finished. But it does mean the short-term structure becomes more fragile. Bitcoin is not only driven by belief, it is driven by flows. If ETF demand slows at the same time that leveraged traders are being liquidated, price can move faster than the long-term narrative. Forced selling does not wait for calm analysis. A trader may believe in Bitcoin for the next 5 years, but if that trader is over-leveraged and price moves against the position, the market does not care about the belief. The position gets closed. That creates more pressure. More pressure can trigger more liquidations, and suddenly what looked like a normal pullback becomes a cascade. This is why support zones can fail quickly. Support does not break only because every investor changes their mind. Sometimes support breaks because the structure of the market forces selling at the worst possible moment. Leverage turns weakness into pressure. ETF outflows can reduce the natural bid. Macro uncertainty can make investors more defensive. And once price starts moving down, the market has to search for the next area where real demand is willing to appear. But this is only half of the story. The deeper question is not only why Bitcoin fell. The deeper question is where liquidity is now. Is capital leaving crypto entirely, or is it simply becoming more defensive? Is money disappearing from the system, or is it sitting in stablecoins waiting for a better signal? This is where stablecoins become important. While Bitcoin moves loudly, stablecoins move quietly. They do not create dramatic candles. They do not generate the same emotion as a Bitcoin breakdown. But they may now be one of the most important hidden layers beneath the crypto market. Many people still think of stablecoins as a simple parking lot for traders. Sell Bitcoin, move into USDT or USDC, wait for the next setup, then buy back later. That view is partly true, but it is incomplete. Stablecoins are no longer just a temporary hiding place. They are becoming digital dollar rails. They are used for exchange liquidity, settlement, cross-border transfers, decentralized finance, payments, and as a bridge between crypto markets and the traditional dollar system. And this is where the story becomes bigger than Bitcoin. Many major dollar-backed stablecoins are connected to cash-like reserves and short-term US Treasury bills. That means stablecoin growth is not only a crypto story, it can also become a treasury market story, a dollar liquidity story, and a market plumbing story. This changes how we should read a Bitcoin sell-off. If Bitcoin falls while stablecoin liquidity remains inside or near the crypto system, then liquidity has not necessarily vanished. It may have become defensive. There is a big difference between liquidity disappearing and liquidity waiting. When liquidity disappears, markets can become disorderly. Buyers vanish, bounces fail, and every rally gets sold. But when liquidity becomes defensive, capital still exists. It simply refuses to take risk until conditions improve. Stablecoins can represent that defensive state. They can be dry powder. They can be waiting capital. They can be the quiet layer beneath the visible panic. But dry powder is only useful if it actually gets deployed. This is where many crypto headlines become too simple. They see stablecoin supply and immediately assume it must be bullish. But stablecoin liquidity is not automatically bullish by itself. It tells us that dollar liquidity exists near the crypto system, but it does not tell us when that liquidity will move, where it will go, or whether investors are ready to take risk again. The missing bridge is confidence. Liquidity plus confidence can create a bid. Liquidity without confidence can sit still. That is the heart of the 66K test. Bitcoin is asking the market whether capital is ready to step forward or whether capital prefers to remain defensive. If Bitcoin stabilizes, ETF outflows slow down, volatility cools, and buyers begin reclaiming lost levels, then stablecoin liquidity could become important fuel for recovery. In that case, the market may later look back at the fall into 66K as a painful but necessary liquidity test. But if Bitcoin fails to recover, if ETF pressure continues, if bounces remain weak, and if stablecoin liquidity stays parked instead of rotating back into risk assets, then the interpretation changes. In that case, 66K may not be a simple flush. It may be the beginning of a deeper repricing. So what should the market watch now? First, watch whether Bitcoin can reclaim lost structure. A bounce by itself is not enough. A strong recovery should show buyers defending higher levels, not just reacting to an oversold candle. Second, watch ETF flows. If outflows slow or reverse, institutional pressure may be easing. If outflows continue, the support zone becomes more fragile. Third, watch the quality of the bounce. A weak bounce after a major support test can be more dangerous than the first drop, because the first drop shows fear, but the weak bounce shows whether buyers are actually strong. And finally, watch stablecoin deployment. Stablecoins sitting on the sidelines are important, but the real signal is whether that liquidity begins moving back into Bitcoin, Ethereum, and broader crypto risk assets, or whether it stays defensive inside the dollar system. This is the difference between panic and structure. Panic is what people feel. Structure is what the market confirms. A calm investor does not need to predict every candle. A calm investor needs to understand what the market is testing. Right now, Bitcoin at 66K is testing three things at once. It is testing whether ETF demand is still strong enough to absorb selling. It is testing whether leveraged excess has been cleared or whether more forced selling remains. And it is testing whether stablecoin liquidity is ready to become a bid or whether it is still waiting in defensive dollar form. That is why this moment matters. Not because 66K is a magic number, but because 66K is where the market has to reveal the quality of its liquidity. If Bitcoin stabilizes and begins to reclaim structure, this drop may eventually look like a liquidity test. Painful, sharp, but not structurally fatal. If Bitcoin fails to recover and selling continues, then the market may be telling us that the repricing is not finished. Bitcoin is the loud signal. Stablecoins are the quiet layer. Bitcoin shows where fear appears. Stablecoins show where capital may be waiting. And between those two signals, the market gives us a clearer picture of how confidence behaves under pressure. So the question is not only whether Bitcoin has hit 66K, the real question is what the market does after hitting 66K. Does liquidity step in, or does it stay defensive? Does the market recover structure, or does it accept a lower range? Does stablecoin capital rotate back into risk, or does it remain parked in the dollar system? That answer will tell us whether this was just a flush or the beginning of a real breakdown. This is not financial advice. This is market analysis for education only. The calm investor does not chase panic. The calm investor follows liquidity.